Good morning. Welcome to Beyond the SEAF Model. I'm Jack Kosar. This is effective for the week of March 16th, 2026. Let's get started. SEAF signals for this week. We retain energy and utilities, and we pick up technology. I have a little bit of a pet theory on technology, not rooted in data, so a little bit abnormal for us here at Asbury Research, but as we can see here, energy has a lot to do with the geopolitical, right? A rising cost of energy, really generating, the reason why XLE is going up. The rising cost of oil. That obviously has to do with our geopolitical movements over in the Middle East. A little bit of a self-own there, but that's kind of what's generating this energy. Straits of Hormuz going closed, the rise of crude oil over $100 a barrel, or hovering around there, depending on where it is today, really driving the energy trade. Like I mentioned in Prism late last week, to be careful with energy. Well, there is some money to be made there. To note that crude oil's standard deviation going back through this year is about 77%. And a lot of that energy move is not necessarily about new technologies or a renewed desire to own energy stocks, but a lot has to do with geopolitical. And with that big 77% standard deviation, that's a lot of fluctuation in the price of oil, which is directly affecting these energy companies. So while it is a SEAF signal, money is still flowing there. We are taking that signal. I'd be remiss to not bring up some of the statistics on the underlying that, this isn't, some breakthrough on crude oil technology that is rushing people into these sectors, but very much based on geopolitics, how Washington is reacting, and being able to kind of move that market around a little bit at a time, and then subsequently, with the straits being closed, generating higher oil prices. But my thought process was, if you look at an SPDW chart, the Europe and Asia really have taken a hit here due to the higher cost, what higher cost of energy does to their economies. And I think a lot of that money that people were putting over diversifying from the United States and bringing overseas to emerging markets and other countries fled quickly and needed to go somewhere. And while the U.S. market has been a little bit, hesitant in terms of, being mostly sideways since October of 2025, that money needed to go somewhere. And it is my pet theory, while I'm not tracking those dollars, the SIN numbers on those dollars from the overseas over technology, I think the safe bet was to bring those risky assets that were in emerging markets back over into technology and continue to try to bet on AI. Again, I don't have direct data evidence of this, but just a little bit of a pet theory of mine. Going back into the table here, away from my conjecture and into real numbers. As you can see here, technology and real estate both have the same overall score of 15. Just as a reminder, when we have the same ranking here, we then default to the new money on the trading week, and technology is higher than real estate. 2 on the trading week for technology, 5 for real estate. Looking, a little bit deeper, financials continues to be in a void, and industrials has that negative skew that we try to avoid. So 2 to 9 to 10, we just traded out of it. Industrials, technology replaced it. And then just taking a look over also at consumer staples, having a little bit of a positive skew, 5, 8, 4. This 4 is a little bit on the weaker side that we're going to see here on the rainbow chart, the heat map. Again, energy looking really strong, 0.65 on the trading week. That's very significant. Lots of asset flows coming into energy. Again, geopolitical in nature. Utilities look strong across the board. 0.21 for the third on the trading week is not bad. And then we got a 0.34 for technology on the trading week. 0.4 is that significant number that we tested. Close, right? And also seeing that positive skew, 10 to 3 to 2. Technology was kind of in that bottom for quite a bit of time. So we do still have that accumulation in that strategic quarter. But as that starts to peel off, if we continue to see asset flows coming in on the trading week, that'll start to potentially start to accumulate, show some positive. Consumer staples, I mentioned, we're going to highlight that in a rainbow chart in just a bit. But overall, negative 0.178 last week. That's data through Friday. 3 of the 5 days last week were down days in terms of asset flows coming out of the 11 sector spiders. While we're there, let's take a look. This chart is through Friday of last week. As you can see here, we crossed down about March 3rd through that 21-day moving average on the sector spider total AUM. If you're new, if you add up the 11 sector spiders AUM into one number and you plot that with the 21-day moving average, that's what we have on top. And on bottom, we have SPY. Just all we try to point out here is when we have assets depreciating coming out of the S&P 500 and we drop below that 21-day moving average, we tend to see price depreciation in the S&P 500. We see that asset flight, that's the sell-off that we're starting to see as those assets climb down. We've been down roughly at 2.18%. I'm filming this on Tuesday this week. We're still working out some technical difficulties on some of our new infrastructure systems. We got a new recording software. So, we'll get these out a little bit back to more regular on Mondays, but that's why we're a little bit late here. But as you can see here, dropping below that 21-day moving average, negative 2.1% through Friday. Overall, again, this isn't the end-all be-all metric, but this has been a really tight, pretty good metric here. Obviously, you can see here in November, picked up that a little bit of that down move, a little bit here also in October. So in general, this has been a pretty good tool in terms of being able to stay on sides or off sides of the S&P 500, and it also holds credence to why the SEAF model works. As we track these asset flows, they have a direct proportional relationship to the market, which is why this model tends to work. Financials, starting off with the least. Financials been in a downtrend really going back to last calendar year. Overall, we've had little spurts of attempts to come into green that have resulted in minor relative outperformance trends, but overall downtrend, and we continue that downtrend. Assets are flowing out of financials at the moment and continue. This is a deep avoid. Consumer staples, just wanted to highlight this. We saw a little bit of a run up here as we've gone from avoid, neutral, and played a little bit with favorite over the last month and a half, seeing a little bit of relative outperformance. We've gone a little bit flat here as we've gone sideways. We really didn't have that extra oomph to get up into the upper favor to really kind of make a run at this. But it's starting, seemingly seeing a little bit of a sideways pattern and some slightly positive, like we said, slightly positive asset flows here on the trading week. Depending on how this thing moves going forward, it's kind of, this is not a lead off or anything of that nature, but this is just a place to watch, watch consumer staples. Any kind of consistent asset flows here could take this thing up, and we got a lot of room to run on the relative outperformance chart. Energy continues to be strong. Broke down through what was kind of a void for a while. We had a little bit of a crater here going on, and then took off. This actually took off toward the beginning of the year, so we've been tracking this energy even prior to the geopolitical marks that happened. But it kind of put gasoline on the fire, so to speak, with that relative outperformance. That's an energy joke. And, as we can see here, really steep relative outperformance versus SPY going back to the beginning of the year, but really kind of taking off. We're sitting in that top spot with three overall score, ones across the board. That's the top score you can have. Energy continues to be a good place to be for now. Utilities look strong as well. Came out of that avoid up through neutral into favor. That generated some nice relative outperformance. We seem to be breaking out a little bit here, or attempting to break out here. So we got some resistance on the relative performance side of this chart. So this is utilities versus SPY relative performance. We can crack through here. We got some room to run, and we've been seeing some nice strong asset throws through time periods. We're starting to pick up some accumulation in that quarter. So as we continue to see some asset flows come in, we've had utilities for a bit. All that starts to accumulate. That's when we get these really nice strong trends. So utilities continues to be a good place to be. Last but not least, technology. Technology is looking good at the 15 mark. Again, being held up by this avoid. We had some real strong accumulation going back into the strategic quarter. That's kind of holding us back a little bit. But we seem to have found ourselves a little bit of a relative performance support level here. September of last year, January of this year, and then early part of March. All kind of lining up as this nice little support level for us to potentially rebound. Like I said, I got my pet theory that all that EEM money and all that international money had to come rushing back when we started the war with Iran. And it needed to go somewhere, and to me, it seems like it's starting to go in technology. So look for technology. We'll see if we continue to make that run. But nice little spurt, directional relative performance off what this seems to be a support level in the relative performance chart. And that's all I have for this week. I look forward to breaking down the SEAF model with you all next week. And thank you.